Hello everyone. Today we're going to review Chapter 8, Chapter 15, and Chapter 16. Chapter 8 is about the portfolio theory and the capital asset pricing model. We've already covered it in the quiz 2, and now we're going to review some simple calculations about the capital asset pricing model. Question 6. CAPM suppose that the treasury bill rate is 6% rather than 2%. Assume that the expected return on the market stays at 10%. Use the betas in table 8.2. And this is the beta, and this is the calculated expected return. And in table 8.2, it's assumed that the interest rate is 2%. And the risk premium is 7%. That is, the market is 9%. But now, the expected return on the market stays at 10%. So A, calculate the expected return from Pfizer. So for this company, the risk-free rate is 6%, and its beta is 0.666, and the risk premium is 10% minus 6%, so it's 4%. Now we get the expected return. So if we calculate for all the companies, we will find the highest expected return that is offered by Dow Chemical, and the lowest expected return that is provided by Heinz, which are respectively 13% and 7.6%. Would Ford offer a higher or lower expected return if interest rate were 6% rather than 2%? Assume that the expected market return stays at 10%. So we simply calculate the case in the textbook in which interest rate is 2%, and compare with the case in this question. Or our simple questions. So if interest rate is 2%, the risk-free rate is 2%, and this is the beta, this is the 10% minus 2%. So we get 14.22%. But if interest rate is 6%, this is the risk-free rate, the beta, and 10 minus 6. Now we have 4% risk premium, so we get 12.12%. So it's lower. And would Walmart offer a higher or lower expected return if the interest rate were 8%? So it's higher. We use the same calculation: risk-free rate, beta 10 minus 2, and risk-free rate, beta 10 minus 8. Question 7. The following descriptions about CAPM is true or false. A. The CAPM implies that if you could find an investment with a negative beta, its expected return would be less than the interest rate. That is true, because the expected return is the risk-free rate plus beta multiplied by the risk premium. B. The expected return on an investment with a beta of 2 is twice as high as the expected return on the market. So it's false, because the beta is not multiplied by the expected return on the market. Instead, it's multiplied by the market risk premium. C. If a stock lies below the security market line, it's undervalued. No, it's false. It's actually overvalued, because stocks that lie below the market line generally are those with higher betas. because in the security market line, the y-axis, the vertical axis is expected return, and the horizontal axis is beta. Question 11. Portfolio risk and return. Mark Harowitz proposes to invest in two shares, X and Y. He expects a return of 12% from X and 8% from Y. The standard deviation of returns is 8% for X and 5% for Y. The correlation coefficient between the returns is 0.2. So we compute the expected return and standard deviation for the following portfolios. There are three portfolios, each with different weights in X and Y. So we use the same formulas with the expected return and the standard deviation. And we plug in the shares, the expected return, the standard deviation, and the correlation coefficient. And we'll get the graph below. And for a single asset X, the weight on X is 100%, and this is the standard. Yeah, the standard deviation is 8% for X, so it's 8%, and 5% for Y. And the expected return for X is 12%, and for Y is 8%. And we plug in the weights, the expected return, and the standard deviation, and the correlation coefficient, and we'll get the expected return of the three portfolios and the standard deviation of the three portfolios. Question 14. Portfolio beta. Look back at table 7.5 on page 179. So we look at the table 7.5. 7.5. No, this is 7.3. Table 7.5. We look at the different betas, and it's arranged from high to low. The highest beta is from Dow Chemical, and the lowest is from Heinz. So what is the beta of a portfolio that has 40% invested in Ford and 60% in Pfizer? So the beta of the portfolio is simply the weighted average of the two betas from two companies. 40% invested in Ford, so it's 40% multiplied by Ford's beta, and 60% multiplied by Pfizer's beta. So we get 1.008. So would you invest in this portfolio if you had no superior information about the prospect for these stocks? Can you devise an alternative portfolio with the same expected return and less risk? The answer is yes, because we have so many stocks to choose from. With no superior information about the prospects for these stocks, this is the best return for the given level of market risk. However, we can achieve the same return with less unique risk. From table 7.3, we know the standard deviations for Ford and Pfizer are 40% and 20%. With 40% invested in Ford and 60% invested in Pfizer, this portfolio will have a standard deviation of at least 20%, depending on the correlation between these stocks. And we can reduce unique risk by adding more stocks. For example, if we had Starbucks, so why do we add Starbucks? Because Ford is here, and Pfizer is here, and Starbucks is in between. So we can reduce unique risk by adding more stocks. We can add Starbucks and construct a portfolio for 3 stocks and 1/3 invested in each stock, and the beta of the portfolio would be 1.05. So it's simply the weighted average of the three betas. And given the higher beta, this portfolio will have a higher expected return and less unique risk with the addition of more stocks. Because we can see that the Starbucks is in between the Ford and the Pfizer. Question C. Now repeat parts A and B with a portfolio that has 40% invested in Starbucks and 60% in Walmart. The logic is almost the same. The beta of the portfolio was 40% invested in Starbucks and 60% invested in Walmart is 0.632, which is the weighted average of these two. And with no superior information about the prospects of these stocks, this is the best return. But we can achieve the same return with less. From table 7.3, we know the standard deviation for Starbucks and Walmart are 26 and 13. So Starbucks is here, Walmart is here. So if we had for example, if we had Exxon added to this portfolio and weight each stock equally, the beta of the portfolio would be 0.78. Given the higher beta of this portfolio will have a higher expected return and less unique risk with the addition of more stocks. Question 17, cost of capital. Epsilon Corporation is evaluating an expansion of its business. The cash flow forecast for the project are as follows. So the first year they invested 100 million, and in the following 10 years they receive a cash flow of 15 million each year. So the firm's existing assets have a beta of 1.4. The risk-free interest rate is 4%, and the expected return on market portfolio is 12%. What is the project's net present value? So we first calculate the required rate of return, and to calculate this, we assume the expansion assets bear the same level of risk, that is 1.4, as the historical assets. And using the capital asset pricing model, the risk-free rate is 4%, beta 1.4, and the market portfolio is 12%. This is the risk-free rate, and this is the risk premium, and we get the expected return is 15%. And we use this to discount future cash flows, and we get the net present value is actually negative. So first year, the initial investment, and in the following 10 years, we see cash flow, and we get negative net present value. So the firm actually shouldn't invest in this project. Chapter 15. How corporations issue securities. Question 3. Explain what each of the following terms or phrase means. A. Venture capital. Venture capital is the financing of startup companies. Book building is that underwriters gather non-binding indications of demand for a new issue. When we say the underwriters are building a book, it's actually not a book, it's an order book. It's actually the documentation of the intended demand from the potential buyers. C. Underwriting spread. is the difference between the price at which the underwriter buys the security from the company and resells it to investors. Registration statement, description of a security offering filed with the SEC. Winner's curse. Winning bidders for a new issue tend to overpay. It's the same as in an auction. So now here's a further vocabulary quiz, briefly explaining each of the following. A, zero stage versus first or second stage financing. So what is zero stage? Zero stage represents the savings and personal loans the company's principals raise to start a firm. First stage and second stage financing comes from funds provided by others, often venture capitalists, to supplement the founder's investment. B, carried interest. Carried interest is the name for the investment profits paid to a private equity or venture capitalist partnership. C, rights issue. A rights issue is a sale of additional securities to existing investors. It can be contrasted with an at-large issuance, which is made to all interested investors. Roadshow. A roadshow is a presentation about the firm given to potential investors in order to gauge their reactions to a stock issue and to estimate the demand for the new shares. Best efforts offer. A best efforts offer is an underwriter's promise to sell as much as possible of a security issue. Qualified institutional buyer. A qualified institutional buyer is a large financial institution which under SEC Rule 144A is allowed to trade unregistered securities with other qualified institutional buyers. Blue sky laws. Blue sky laws are state laws governing the sale of securities within the state. Green shoe option. A green shoe option is an underwriting agreement gives the underwriter the option to increase the number of shares the underwriter buys from the issuing company. Chapter 16, Payout Policy. Dividend payments. In 2012, Entergy paid a regular quarterly dividend of 0.83 dollars per share. Question A, match each of the following dates. So we have the declaration date, last with dividend date, ex-dividend date, record date, and payment date. That is the usual process when we are paying out a dividend. So we match the date with the order of the following. First, the declaration date, second, last with dividend date, third, ex-dividend date, fourth, record date, and fifth, payment date. So after matching, we get A1 to B5, A2 to B4, A3 to B3, A4 to B1, and A5 to B2. On one of these days, the stock price fell by about 0.83 dollars. Which day? So it's February the 7th. The ex-dividend date. On the ex-dividend date, the price will fall by approximately the dividend amount because buyers of the stock on the ex-dividend date are not entered on the company's books before the record date and not entitled to the dividend. C. Entergy's stock price in February 2012 was $68. What was the dividend yield? So the company pay out the dividend in quarters. Each quarter, $0.83 dollars. So the dividend yield to the stock price is 4.8%. D. Entergy forecasted earnings per share of about 6 for 2012. What was the payout ratio? the same calculation. Each year, 4 quarters, each quarter, $0.83, and this is the earnings per share. So the payout policy is actually 55%. Suppose that Entergy paid a 10% stock dividend. What would happen to the stock price? So since the stock dividend dilutes the ownership of the existing shareholders, the price would fall to, because there is an additional 10% outstanding stocks, so the price would be 68 over 1.1, so it's actually $61. Dividend policy. Here are several facts about typical corporate dividend policies which are true and which are false. The first is false. Companies decide each year's dividend by looking at their capital expenditure requirements and then distributing whatever cash is left over. This is false, because the dividend depends on past dividends and current and forecasted earnings. B. Managers and investors seem more concerned with dividend changes than with dividend levels. True, because dividend changes convey information to investors. C. Managers often increase dividends temporarily when earnings are expectedly high for a year or two. False, because dividends are rarely changed dramatically. Dividends are smooth. Managers rarely increase regular dividends temporarily. They may pay a special dividend, however. D. Companies undertaking substantial share repurchases usually finance them with an offsetting reduction in cash dividends. This is false, because dividends are rarely cut when repurchases are being made. 27. Repurchases and earnings per share. Many companies use stock repurchases to increase earnings per share. If they have the following position, the company now repurchased 200,000 shares at $200 a share. The number of shares declines to 800,000 shares, and earnings per share increased to $12.5, assuming the price earnings ratio stays at 20%, the share price must rise to 250. Discuss. This is not the right calculation. You cannot simply increase your earnings per share by repurchase the stocks because you have to spend money to repurchase the stocks. So one problem with these analysis is that it assumes the company's net profit remains constant even though the asset base of the company shrinks by 20%. That is, in order to raise the cash necessary to repurchase the shares, the company must sell assets. If the assets sold are representative of the company as a whole, we would expect net profit to decrease by 20% because we spend money to repurchase 20% of the outstanding share. So the earnings per share and the P/E ratio will remain the same. After the repurchase, the graph will be like the following. Net profit, 8 million, number of shares, 800,000 shares, and earnings per share, still $10, price earnings ratio 20, and the share price will be the same. Dividends and taxes. This question is about the tax policy. Dividends and taxes. The middle of the road party holds that dividend policy doesn't matter because the supply of high, medium, and low payout stocks has already adjusted to satisfy investors' demands. Investors who like generous dividends hold stocks that give them all the dividends that they want. Investors who want capital gains see ample low payout stocks to choose from. Thus, high payout firms cannot gain by transforming to low payout firms, or vice versa. Suppose the government reduces the tax rate on dividends but not on capital gains. Suppose that before this change, the supply of dividends matched investor needs. How would you expect the tax change to affect the total cash dividends paid by U.S. corporations and the proportion of high versus low payout policy companies? Would dividend policy still be irrelevant after any dividend supply adjustments are completed? Explain. So even if the relationship between tax policy and the dividend payout are true, we still do not know why investors wanted the dividends they got. So it's difficult to be sure about the effects of the tax change. If there is some non-tax advantage to dividends that offsets the apparent tax disadvantage, then we would expect investors to demand more dividends after the government reduces the tax rate on dividends. But if the apparent tax disadvantage were irrelevant because there were too many loopholes in the tax system, that means if we can avoid the tax in many other forms, then the reduction in the tax rate on dividends would not affect the demand for dividends. In any case, the middle of the roaders would argue that once companies adjusted the supply of dividends to the new equilibrium, dividend policy would again become irrelevant. So to summarize, there are 2 points. First, we do not know why investors wanted the dividends they got. And the second, if there is some non-tax advantage to dividends. And third, if there are too many loopholes in the tax system. 29. Dividend policy and the dividend discount model. Consider the following 2 statements. Dividend policy is irrelevant, and stock price is the present value of the expected future dividends. They sound contradictory, right? This question is designed to show that they are fully consistent. The current price of the shares of the Charles River Mining Corporation is $50 per share. Each year's earnings and dividends per share are $4 and $2 respectively. Investors expect perpetual growth at 8% per year. The expected rate of return demanded by investors is 12%. We can use the perpetual growth model to calculate the stock price, which is the dividend over the required rate of return minus the growth rate. So the stock price equals 50. Suppose that Charles River Mining announces that it will switch to a 100% payout policy, issuing shares as necessary to finance growth. Use the perpetual growth model to show that the current stock price is unchanged. So in this case, the firm does not give out more dividends from nowhere. It issues new shares to finance its growth. So reducing the amount of earnings retained each year will, of course, reduce the growth rate of dividends, but the company is issuing new shares to finance it. So under the original dividend policy, we expect next year's stock price to be, the growth rate is 8%, so next year it will be $54. If N is the number of shares previously outstanding, the value of the company is M multiplied by 54 per share. Under the new policy, however, N new shares will be issued to make up for the reduction in retained earnings resulting from the new policy. So in the old policy, the dividend is 2 and the earnings per share are 4. And in the new policy, the dividends is 4 and the earnings per share stays the same, it's still 4. So the decrease in the retained earnings is $2 per original share, and the aggregate reduction of the total outstanding shares is N multiplied by 2. So if P1 is the price of the common stock at T equals 1 under the new policy, then the company would issue N new shares to finance the 2N reduction in retained earnings. So we must have the following equation. This is the new issuance to finance its growth, and this is the reduction in earnings. So it has to issue new stocks to compensate for the gap. Also, because the total value of the company is unchanged, so we must have the following equation. This is the under the 8% growth rate, what the value of the company would be. It should be N multiplied by 54. But now we have issued small n new shares, so the new value would be capital N plus small n multiplied by the stock price. So we must have that the stock price should be 52. And if G is the expected growth rate under the new policy and P0, the price at T equals 0, we have to reach the 52 from T equals 0, we must have the initial price multiplied by the growth equals 52. And we also have the perpetual growth model in which the dividend is $4 and the required rate of return is 12%, and this is the growth rate we want to get. So we solve those two equations simultaneously, substituting the second equation above for P0 in the first equation, and then solve it. We find that G equals 4%, and the P0 should be $50, so that we know under two different policies, this is the old policy and this is the new policy, the current stock price are both $50 per share. So it is consistent with the statement that dividend policy is irrelevant, but stock price is the present value of the expected future dividends from this calculation. So the most important part in this question is that why are these two statements consistent? Because the firm issues new stocks to finance its new payout policy. So that's all for the 3 chapters. Thank you.